afternoon, everybody. Thanks very much for joining us here for the European Logistics Real Estate Markets Is Now the Right Time to Invest briefing, where we'll be picking up on the latest research from GARBE and also Oxford Economics, and picking up on your views, your questions, and looking at the outlook for the logistics markets across Europe. For those who don't know me, my name's Richard Betts. I'm the head of content at Real Asset Media, and we publish magazines, newsletters, Real Asset Insight, Real Asset Impact, Real FDI. So we're focused across really those real estate markets, but our focus is very much less on the news and more on analysis, research, investment strategy, the kind of things that are going to be driving the markets. Super panel lined up for us here. So what I'd like to do first of all is just introduce some of the speakers. We have Tobias Kassner, we have Moritz Schmidt, both from GARBE Industrial Real Estate, and also Oliver Rakow from Oxford Economics. And the programme for this morning is we're going to look at the GARBE Pyramid Research Map with Tobias Kassner. Really interesting research, and we're onto a number of these now, and so we're beginning to see trends coming through, and fascinating to see that. It's one of the things that I always look out for in terms of the research and analysis that I'm checking. And then Moritz will also pick up on some of the fundamentals in terms of the Dutch logistics market, and Oliver will then look at, I guess, how the macro side is driving some of the investment markets and also the demand. So a lot of content to pick up on, and then of course there'll be your chance and my chance to ask questions. And the idea is that it's an interactive discussion. So we're very much looking forward to your questions. So please do put things in the chat, and I will aim to pick those up. But for now, over to you, Tobias, and really interested to see what the pyramid research is telling us this time.
Yeah, thank you very much, Richard. I will dive right to in the middle. It's the 8th edition of our pyramid map, and I guess together with you as well, 8 rounds of the pyramid webinar. We're presenting this as a map to introduce more transparency on the pan-European logistics real estate side. When we started with this, we had the situation that when we rolled out our pan-European approach at GARBE, we didn't find too much information on a detailed level when it comes to the most important two KPIs, rents and yields. We are covering 116 sub-regions, sub-markets in 24 countries. So our first goal was to get transparency on the market as a status quo, and we achieved this. And we want to share it with you being able to have the same transparency and view on the market at the moment. If you want to get those information in your inbox, then we'll send afterwards out our slide deck and you can sign up. So you will receive the pyramid editions in your inbox automatically. Don't worry, it's not spam, it's just 2 times a year, the pyramid map, 2 times a year, a short research newsletter. What is new this time? Richard already introduced Oliver. We partnered up with Oxford Economics, a really strong partner when it comes to real estate economics, the views, the forecasting. So what we try to aim is not to having a view at the situation, and our teams, with boots on the grounds, and my colleague Moritz is with us today from the Dutch team. They really know what's happening at the moment, and they know what the yields and rents are looking like, and we are putting it all together on these maps. But forecasting it for the next years gives us all the opportunity to formulate really a strategy based on how the trajectories for the future will look like. And now we will dive into the details. Of course, when we have 116 sub-regions available, there's much to tell. I made this as brief as possible, but stay tuned for our website, for our press release, for the maps really itself on our website, to have all the numbers and figures we don't show you today at your fingertips. So looking back to the last 2 years, it was quite, much going on, but we can focus this on one point, on the 22nd of July, 2022. Why is that? And these days, the new or the increased interest rate took effect. And this is why it was quite very sharply paced when it comes to the differences in the market. For example, the investment volume or the repricing or the yield levels. When it comes to the user demand, we didn't see so much difference for the time being. For example, if we look at the take-up, we see that 2022 was quite one of the most intense years we saw in the markets. In some countries, even the record-breaking still. And we had a downturn or a decrease in turnover just in 2023. For 2024, it looks like we are able, when using Savills data, to nearly touch the 10-year average. So it's not much of an big issue when if I say so. It's not something dramatic, but it's just coming back to the average non-pandemically boosted market situation. And we will discuss it later on with Moritz, what the situation in the Netherlands is looking like. When it comes to the transaction volume, the story is a little bit different. We had a decrease of roughly 50%, so quite a dramatically changed environment we had to face. On the other hand, logistics was still one of the most sought asset classes in real estate in all these years. We have an increase to an investment volume covering a fifth or quarter of the market. And this is what the situation was in the last years. When we see or analyze the framework condition, we still see many red flags or many red lights here. For example, the interest rates are, in contrast to the last years, still very high. When it comes to the situation decades ago, this is just a situation we had in former times as well. But for the moment, we were adjusted to such kind of low interest rates, the low financing condition. This is going to be, we will face a slight relief because of the inflation, which is being reduced really quite good. Oliver will talk about the inflation later on. So we have a situation that the interest rates will begin to drop. Does it change many things for the moment? No, because it's all already priced in. And when it comes to effect, it will typically take 10 to 12, 15 months until it takes effect. Of course, later then we will have a bigger impact. But for the moment, for the time being, not. Especially in Germany, we are a little bit concerned about the economy. That's why we see it still covered in red. We have not a big recession, but you have a very flat development for the situation at the moment and for the future as well. We'll discuss it later on in our panel discussion, what it means for our industry. But for the time being, we want to look into the rent and yield developments a little bit more into detail. And together with our pyramid research, we are using the swarm intelligence on LinkedIn, for example, how the panel sees the development. And it's good to see that they have quite a good understanding of the market environment, as they also see that the rental developments will be very constant. It's not dramatically decreasing or not increasing anymore. When it comes to the yield development, it comes to a constant development for the future. So it's not a big decompression anymore, and compression has not yet begun, but it's on a very stable fundamental situation at the moment. Going more into the details of the pan-European rents, when we drill down to the different countries, we see we faced a really big increase. It even started after the Ukraine war began because of the increase in construction costs and the cost for plots of land, and coming on top of this, the increased costs of financing. So this is also reflected into the rents when it comes to new top-of-the-line products. And on top of that, we had a few, I just showed it on the slide with the take-up, very high demand and very low vacancy rates. So both in combination led to the high increase of the rental values. For example, in the UK, 42%. And in the Netherlands, even it was 43%. So the biggest increase in the last 5 years. The other countries, you can see it here, increased as well, but compared to the UK, of course, this was on a much lower scale when it comes to the total value for 1 square meter. But in percentage spoken, it's quite steep in the development as well. When we drive or drill down to the pyramid markers, we have 3 different aspects. We have the top markets. Those are the 30 markets we calculated forecasts valued with Oxford Economics. And we can see here an increase from the beginning of 2019 to the current situation after 1/2 year of 2024. With plus 2.30 euros on a square meter, or an increase with 83%. The next secondary markets are, of course, a little bit deeper in there or lower in their increase, but still it's 1.75 euro or 33%. And as you can see, the biggest increase we saw in the second half of 2022. Like I said, there was this turning point in the beginning of, or in the middle of 2022. It's quite similar that it didn't have such an impact on the rental developments, in contrast to the yield development we see in a few minutes. And it's well, the second or the year after, when together 2022 and 2023 together, we had double digits increase when we combine it, the rental increase, and this is all across the markets. We see it in the top markets as well as the secondary market, and in general in all of the logistics regions. When it comes to the 2023, we saw quite a decrease in further increase. So for the logistics region in general, we only saw a further increase in 2.8% in the second half of 2023, and in the first half year of 2024, a much lower increase with 1.4%. So we can really see that that the rental development lost its dynamic, and it's really coming to a more or less stable development for the moment. When we look at first time to the forecast values, we see this won't be the situation forever. We will see in many of the countries a short time of a flat development when it comes to the situation that the current economic the situation is not so dynamic. But afterwards, if the economic situation will gain its foothold again, although we'll talk about it later on, we see the further increase in rental development for the next 5 years. This is because the vacancy rate is in many different submarkets still very low, in some points still on an historical low situation. We don't see so much available plots of lands. If you, for example, look into the logistics region of Hamburg, you won't find any large available parcels to build up new plots. So the development will, together with the high construction costs, plots of the cost components in general, lead to a further increase. The market with the highest increase we will see in inner London, and therefore we made an additional chart on the left side, because it's so much away when it comes to the total level of rental values in contrast to the other countries. We're seeing here rental levels above 30 euros a square meter, so we had to make sure this one will be seen as well. For the future, we won't see such a dynamic increase again, because much of the dynamic is lost. We still will see an increase for most of the, or here for the 30 markets. And I highlighted some of the markets with a with the lighting bulb. For example, Munich, because it's one of the markets with the highest increase in general, because there's no plot of land available, or nearly no. There's even not much workforce available anymore. So the demand side is still so driving that the increase will continue for the future. But, and this is more or less aligned for each sub-regions, on a lower scale than for the last 5 years. Then again, for example, there are logistics regions like Duisburg, where the prime rent development was really steep, but not many people are having Duisburg on the radar. So we're presenting some kinds of the markets where there's much dynamic, much demand, but not everyone would grade this as a market, for example. And then again, here, for example, I told it already, Hamburg, where there's nearly no plot of land available anymore. So here it's natural that the rental level is increasing from the demand side as well. Coming to the yields. When we showed the rental development, we had in the same period quite just an increase with a slowing down of the dynamic at the end of the line. But here we have a sharp turning point, and this is again more or less correlated with the change in interest rates in the middle of 2022. We have 7 quarters where we saw a compression in each of these countries. And then we have only 5 quarters with an increase. For example, if you look at Poland with an increase of 145 bips, we're seeing an even higher yield level than we saw at the beginning of this time series in the middle of 2019. And this is the market, Poland, with the biggest increase. Afterwards, Germany really faced the biggest increase. And there are some markets like the Netherlands where we have more or less a stable development already in the first half year of this year. Whereas in some countries like Germany, the decompression phase was not over yet. And we are just about to reach the turning point. Drilling down to the pyramid markets, we had an increase in the top markets for 130 bips, and this took only 5 quarters, whereas here we needed 7 quarters to have a decompression of 90 bips. So the pace of the developments was so fast that it was really difficult for many participants in the market to adapt to the new environment. And we'll discuss this later on, how it will be in the future and what the situation was we had to face during this period. And here again, we see that the dynamic is slowing down in the first half year of 2024. In any of the market breakdowns, we saw only a slightly further decrease. So the decompression phase is coming to a halt when it comes to the pan-European view. For the future, we see there will be a decompression phase again, beginning somewhere by the end of this year, beginning of next year. And what's interesting to see, we don't expect, or the colleagues from Oxford don't expect that the yield levels will reach such a low level then at the highest phase of the market by the end of 2021, when we reached in some markets levels nearing 3%. This is because the framework conditions are so different, especially when it comes to financing costs and some other cost components, and of course the investment alternatives we see despite of real estate. For example, here we had for a long time period a very big yield spread. For example, if you look at the spread in 2015, and this spread was a little bit smaller, but still very or you can see it by the end of 2021, 2022, it was quite big, and this changed dramatically in a very short time, where the spread was narrowing down. And in this phase, alternative investment products were, for many of the traditional institutional investors, more in favor. But If we look, and this is one slide which is not part of our pyramid project, this is from Lazard Investment. If you look what people focusing in real estate, investors focusing in real estate are interested in, they are interested in a more value add or opportunistic approach. For example, developments or in secondary or tertiary locations, or in products which is not being core at the moment. And this is quite, for us at GARBE, a good situation, because we already are, since many years, a specialist in a manage to core approach. And as we're all, and this is interesting to see as well, that the sentiment from Lazard tells us that market specialists, which really are into sectors or markets, and not being a mixed use scheme or mixed portfolio, that is really in favor of the situation. And from this point of view, logistics real estate investment is really still interesting for many investors. They're quite different from what we saw in the past when we look at the market participant. And if you see our press releases, we work together with companies like BlackRock or other companies, and they are other companies like the German institutional companies, which were very active on the market in the market phase before. And with this remarks, I hand over to Moritz to give us a deep dive into the Dutch market. Thank you very much.
Good afternoon, everyone. And thank you, Tobias, for the comprehensive and detailed overview of the European logistic market and its trends. My name is Maurits Smit, and I'm the Managing Director at GARBE Industrial Real Estate Netherlands, based in Amsterdam. I'm responsible for the Dutch market, overseeing currently a portfolio for 1.2 billion assets under management. We have 3 live developments under construction, and we do have a development pipeline of roughly 200,000 square meters. The GARBE office opened in 2018, and in 2023 we got rewarded for being the 3rd largest logistic developer. Over the next 10 minutes, I will share key insight in emerging trends on the Dutch market, which remains, to my view, one of the most in-demand and strategically significant markets in Europe. We will explore the market fundamentals that make the Netherlands a key player. We discuss the current challenges, but also the opportunities, and highlight why it continues to be a great market for investments. Can I go to the next slide, please? Thank you. Let's start by looking why the Netherlands is such a crucial logistic hub in and for Europe. The Netherlands is centrally located and has excellent connectivity with the rest of the continent. It is also shown by the country's freight transport numbers. From 1998 to 2022, the Dutch market has maintained high levels of freight per capita, significantly outperforming the European average. One of the main reasons for this is the port of Rotterdam. As the largest port of Europe, Rotterdam is the main entry point for goods going to the whole continent. This gives the Netherlands the highest total freight per capita of 33 tons, compared to the European average around 6 tons per person. This makes the Netherlands a key logistic hub, not only for Europe, but globally. Since 2016, the Dutch market has constantly ranked 2nd in Europe for e-commerce sales shares, highlighting the country's strong digital infrastructure, widespread internet access, and consumer base that is comfortable for using technology. This high level of e-commerce activity has led to increased demand for logistic real estate, especially for warehouses and logistic centers optimized for quick and efficient handling of online orders. According to the report by Modern Intelligence, the e-commerce sector in the Netherlands is expected to grow at a compound annual growth rate of 9% until 2029, which is above the European average of 8%. Another significant trend is the rise of nearshoring. Companies are moving production closer to their consumer markets to reduce risk associated with global supply chains. Nearshoring helps reduce costs, improve efficiency, and enhance supply chain reliability, which is crucial in an era marked by global supply chain disruptions since the COVID pandemic. The Netherlands, which is a strong infrastructure and political and economic stability, is well positioned to benefit from this trend. On the next slide, let's turn the attention to something that Tobias also already mentioned, but which is one of the most crucial issues currently shaping the Dutch logistic market: scarcity. Specifically, we are seeing both development land and warehouse supply scarcity significantly influence market dynamics, creating both challenges and opportunities for investors and developers alike. The scarcity of development land has been a known issue for years, but it becomes even more noticeable recently. Limited land availability, strict regulations, and issues related to the electricity grid are making new developments more complicated. Grid capacity is becoming a bigger issue and is limiting where and how new logistic facilities can be built. In some regions in the Netherlands, the grid can't support new large-scale developments due to the capacity issues, making it difficult to proceed with planned projects. On the next slide, we can see that the rising construction costs are also making things worse. The cost of capital, labor, and compliance with stricter environmental standards has risen in recent years. These rising costs make it less financially viable to pursue new developments, especially in a market where zoned land is already scarce and expensive. Maybe good also to add is that we are currently seeing that the construction costs are going down, but not in the same way how it went up over the last years. As a result of these constraints, there has been a noticeable decline in the number of new projects. However, this scarcity has also led to a shift towards brownfield developments, where previously developed land is repurposed for new use. Brownfield developments are becoming more attractive as they offer solutions to the limited availability of green sites, face fewer electricity capacity issues, and can often be brought to market more quickly and efficient. Despite the slowdown in new developments, demand for high-quality logistic properties remains strong. This persistent demand, coupled with the limited supply of new developments, is expected to drive rental growth in the market. According to CBRE, we can anticipate a rental growth of between 4 and 6% over the next 12 to 18 months, but I think in some regions it can even be slightly more. In regions such as Flevoland, to the northeast of Amsterdam, and the south and central Limburg in the far south of the country are expected to see the most significant increases in stock over the next 2 years. For investors, this presents a great opportunity. When considering future investments or developments, it's crucial to focus on regions where the take-up of logistic properties exceed current vacancy rates and available pipeline. Additionally, assets that outperform market standards should be prioritized to ensure long-term value. In conclusion, while the Dutch logistic market faces significant challenges due to the scarcity, opportunities remain, particularly in strategic regions and through brownfield developments. Staying informed and active in response to these market conditions will be key to navigate this complex landscape. To my last slide, let's discuss the positive momentum in the Netherlands. Over the past few years, logistic real estate in the Netherlands has seen a significant surge in popularity. This is also shown by Tobias before. And it's reflected in the investment volumes, which over the multi-year average stand at 3.2 billion per year. However, in 2023 and also early end 2022, we observed a notable decline in investment volume. This decline was primarily driven by the reduction in the number of investments as the interest increased and therefore the allocation of investors in real estate changed. Despite this reduction, international investors continue to show strong interest in the Dutch market, particularly in value-add and development products. This ongoing trend shows the underlying strength and potential of the market. Another indicator in the market health is the trend in the prime net yield. Over the past 4 years, prime net yields had decreased sharply, dropped over 180 BP. However, in the last 3 years, yields have started to rise again, averaging 4.9% across the logistic regions. Currently, yields are expected to compress slightly again, primarily due to the favorable expectation around transfer tax and interest rate reductions. To illustrate the kind of opportunities available, consider the recent deals in the market. For example, in Venlo, a new BTS deal for 50,000 square meters with a BREEAM Very Good certification achieved a net yield of 4.75%. Similarly, in Ridderkerk, a newly built 40,000 square meters facility with a BREEAM Excellent certification and a WALT of 15 years gained bids with an NOI of around 4.8%. These examples highlight the kind of high quality assets available in the market today and the attractive yield that investors can achieve. In conclusion, who knows what the future may bring, but the fundamentals of the Dutch logistic market remain exceptionally strong. Despite challenges such as land scarcity, the market continues to offer significant opportunities for investors. With rental growth expected to continue and yields likely to decrease slightly in the near future, we believe that the Dutch market should be a key consideration for real estate investors. Now over to Oliver.
Thank you so much. In the next couple of minutes, I will now try to give you a bit of a background on the macroeconomic assumptions that have been going into the forecast of the new map that Tobias and the other colleagues from GARBE have been presenting. But as a starting point, I think it's useful to have a little bit of a discussion about the status quo. And one thing is for certain, Europe has certainly underperformed globally and especially in comparison to the US over the past couple of years. For instance, if you look at the Eurozone, GDP growth since 2019 has roughly been half the what we've seen in the US. So roughly 5% compared to over 10% in the US. However, and that I think is a big however, especially when we talk about the Netherlands, there has been a big divergence across Europe. We have seen Germany and to a lesser extent France underperform the average in the Eurozone, but we have seen Netherlands, which is marked in red here on this chart, significantly outperform the Eurozone average. And in fact, several of the Eastern European economies in Europe have even outperformed the US. What does that mean for the logistics? Even if you have some economies that are underperforming, like Germany, for in part domestic reasons, because it was severely impacted by the inflation outburst and the energy crisis, but also because of the structural challenges as regards the transition to EVs that it is seeing. It does not mean that logistics necessarily underperform severely, because Germany being in the heart of Europe, Netherlands similarly given its transport connections, if you have other regions inside Europe that perform strongly, you should still see benefits for the logistics markets. Let me now turn towards the outlook, and that is admittedly a bit more mixed, if you will, for Europe. We do not think that there will be a significant upturn in global growth in the next couple of years. We are seeing around 2.7% real GDP growth at the global level this year, and not much different numbers in the next couple of years. In fact, towards the end of this decade, we expect global GDP growth to slow towards more like 2.5%, and that's significantly less than the 3% and more that we have seen in the previous 2 decades in the run-up to the pandemic, but also, of course, that was the period in which China was integrated in the world economy and which saw the biggest surge in globalization. So we do not expect a return of this environment. We expect a more moderate and on average slowing economic growth in the next couple of years. However, and I think for Europe that's important, where we think that in China there will be a continuous slowdown, for instance, in GDP growth, given the fundamentals, and a bit of a moderation in the US, we do expect a bit of a pickup in growth in the Eurozone in the next 2-3 years, after we have seen something like a half or 1% growth last year. And this year, we think 1.5 to maybe up to 2% in the next couple of years is possible. That will still leave Europe behind the US. Nonetheless, it will certainly be a more positive backdrop for the economy. And there's a couple of reasons that we think that there's a good medium-term outlook. And that is despite some of the challenges that Europe faces. All of you are, of course, highly aware that Europe faces a lot of demographic headwinds. Basically, population dynamics are on a downward trajectory. So take Germany, you would probably need around 400,000 immigrants a year just to keep the workforce constant. And this backdrop just means, in our view, that in the next 10, 15, 20 years, the potential GDP growth, like what's possible given the underlying fundamentals of the economy, will be slower than what we've seen over the past 2-3 decades. And the main headwind will be coming from the labor supply side. The takeaway from this, of course, that there are other inputs into the economy, such as capital and technology. And here, I think there's a bit of a positive spin to be made. What we have done in the last couple of months is try to assess what AI can potentially yield to the economic outlook. On the right-hand side of this slide, you see our estimates for what the impact on US GDP levels can be in the next 5 to 10 years. And it's quite significant lift of between 1 to 4%. Admittedly, it's highly uncertain. That's why I don't want to put too much of an emphasis on this. But in the context of an underlying slowdown in the economy, even a lift of a couple of percent should be quite valuable. In Europe, we assess that maybe half of the growth lift that the US is seeing could materialize. And that's certainly quite welcome given the weakness over the past couple of years. But probably for the logistics markets in particular, and in general also for the industrial outlook, what's much more important is the outlook for monetary policy and industrial activity. On the left-hand side, what I'm showing here is our forecast for central bank activities in the next couple of years. And what you see with the yellow line is that we expect the ECB to continue cutting its policy rates in the next couple of quarters. In fact, we think policy rates could go down back to something like 2% by the end of next year. In fact, that is already priced in broadly by financial markets, which currently see the policy rate even undershooting 2% by the end of next year and early 2026. And this will, of course, be a very different financing environment than we've seen over the past 2 years. As Tobias said, it's not back to the low interest rates or even negative interest rates that we've seen pre-pandemic, that's for sure in our view. Nonetheless, the Eurozone, given its structural headwinds, is unlikely to see elevated interest rates as we have right now for very long. We think the neutral policy rate is somewhere around 2%. So in cyclical normal times, that's what we would expect to see. And indeed, that's what we forecast for later next year. Another positive factor for the outlook should really be from the industry side. Of course, the European industry has suffered a severe setback in terms of competitiveness given the lift in energy costs. We are also not as well placed to benefit from the renewable investment maybe, but also from the technology and AI boost. Nonetheless, some of the recent developments have dragged down industrial activity below what we think is normal. If you look on the right-hand side of the middle chart, energy-intensive sectors have dropped by 15-20% in terms of output in the last 2 years, but currently there's a recovery underway. That is partially because energy costs have fallen, but also what's important to know about energy-intensive sectors is that they are mostly intermediate goods, and thus they were quite severely affected by the adverse inventory cycle that we have seen. We have heard that there has been stockpiling by firms after the supply bottlenecks in the wake of the COVID crisis, but in the last 1 to 2 years, many firms have faced an environment where stocks were too high given demand. Stocks got expensive because interest rates were rising, so many firms were also trying to cut down a little bit on the inventories, but we think that drag is actually now gradually being fading. And if you combine that with the outlook for falling interest rates, which typically does boost construction activity and industrial activity, and it does boost consumer goods demand. All of this tends to be good news for inventory holding and also for industrial activity in Europe. It's not a boom that we're expecting, but certainly we expect quite a robust recovery, which tends to also lift logistics activity. Now, the other big question for Europe, of course, is there's a lot of discussion about deindustrialization in Europe and deglobalization. As regards deindustrialization, we do not think that will happen. What we think is much more likely is that there's significant material and long-term shift in industrial activity underway. So things like chemicals that are in need of electricity, energy, and gas are likely to play less of a role in the future. That's what you see on the right-hand side. Similarly, rubber and plastics are energy intensive, but also motor vehicles and parts. Europe has probably lost some competitiveness in this regard. Nonetheless, Europe has a lot of competitiveness in other areas, some in the high-tech goods, pharmaceuticals. Think of the boom in Denmark recently, or in the Netherlands, production of machines to make computer chips. All of these things are actually going to be a positive, put a positive spin on industrial activity. So in our view, it's less deindustrialization as a shift between different sectors. And in some ways, actually, you can already see that being underway. On the left-hand side, you see, yes, Germany has seen quite a dramatic drop in its trade surplus in trade with new cars. That's the blue line. However, what's interesting, by now half the trade surplus in new cars that Germany has is actually in EVs, despite all the discussion about the competition from China. So there is some positive news here and there. You see a gradual adoption of European firms to the new challenges. It's certainly not a home run, and it's not a bright outlook, but there's certainly a lot of reason to expect that the industrial activity will grow more quickly than the past couple of years, and in fact may somewhat outgrow the wider economy for 2-3 years as it recovers. A last word, if I may, is on the outlook for globalization, or more like deglobalization. It's, of course, a big theme. And in fact, if you look at the data, globalization has broadly stopped back after the financial crisis. Since then, the global import share in global GDP has actually held roughly stable, and it's one of the potential measures of globalization. So the way we have phrasing this, it's more like we have already been for a decade or so in a world of slowbalization rather than deglobalization, and we think this environment is broadly going to continue with maybe a little bit of upside after the recent weakness. Couple of the reasons, of course, we all know: trade restrictive measures, tariffs by the US, but also others have been introduced. This has been weighing on the trade shares or on trade developments. Nonetheless, even if global trade only grows in line with GDP growth or slightly higher, that would still give you something like 3% real growth in trade, and thus logistics activities in the next couple of years based on our assumptions. And the very last point I want to make in terms of nearshoring and homeshoring, it has been, of course, a big discussion. What would happen in the wake of supply chains and all these trade disruptions? On the left-hand side, what you see is some research from the ECB, and that one has shown that up to 2022, that's the data available for their analysis, you have seen more friendshoring than nearshoring, meaning Europe importing more stuff from, say, Vietnam and India rather than China, and not so much of nearshoring of Europe towards Eastern Europe. But on the right-hand side, what I've done is look at the trade shares or imports of the Eurozone from different regions. And what you can see is there has been quite a significant increase in imports from Eastern Europe, but also from Mediterranean countries that are not inside the EU. And we see this as one potential sign of more nearshoring activities now happening, as basically the whole supply chain is gradually adjusting it as all the investments are materializing. Nonetheless, if you look closely at the chart there, import share from China is also up a little bit. So it's really still a bit of a preliminary takeaway. It's quite mixed, but the big rise in imports from the Eastern Europe is certainly, I think, in my view, pointing to nearshoring now gaining traction, which of course is one of the opportunities within the framework of a globalization world that is seeing less trade growth than it has in the, let's say, 2010s, for instance. And with that, I'm happy to pass over to the moderator again.
Great, really interesting series of presentations there. Thanks very much, everybody. Lots to pick out of that. I also like the phrase globalization, which I hadn't come across before, Oliver. So very good. Maybe, Oliver, let's pick up with you. And of course, everybody, please do put any questions that you've got in the chat, which is just on the right-hand side of your screen, and I'll make sure that we pick up those questions. Let's just pick up a little bit on some of those things. Firstly, with you, Oliver, I think, in terms of the Mediterranean shift towards Eastern and Mediterranean countries, do you see that continuing? What's your sense of that? Does that mean, I guess if we logically look at that there's going to be more of a focus around logistics in those areas as well? How do you see the growth of that, particularly Eastern Europe and the Mediterranean side?
I mean, it's very hard to say because a lot of things are influencing it. So, for instance, the increase in trade with the Mediterranean is in part just us importing more energy from the gas producers in Northern Africa. So it's a bit of a grain of salt. But in terms of Eastern Europe, I think it's quite obvious that those economies are still very competitive. There has been a big growth story in countries like Poland or Romania, but also Hungary. Despite that, they're still cheaper than Western Europe for sure, and thus there's still quite an incentive to reallocate some production to there, compared to Germany, for instance, where wage costs are quite high, energy costs have risen, and the demographic decline we have just means the outlook for labor supply is just weakening. Eastern Europe has some supply issues themselves. Weakening demographics are a factor, but in terms of cost, they're still quite competitive. There's still scope for participation rates to increase, for productivity to pick up to Western European levels. So we are quite optimistic actually still on several of the Eastern European economies, which does suggest that there's some reason to relocate there. But even there is a kind of like a ceiling, if you will, given the structural outlook. So that's why we think the next logical step, even if harder to achieve, would be to look outside the EU, like Southeastern Europe, for instance, maybe to a degree Northern Africa. Some of that is happening, but there's certainly more scope. But attaining that growth potential is, given political instability, probably a bit harder than in Eastern Europe, where just the kind of environment is much more similar to what we have in Western Europe.
Yeah, really interesting, I think. I wanted to pick up with you, Tobias, a little bit around that, and Oliver, or Moritz, feel free to come in on how you're seeing this. But do you think there's a bit more of a decoupling now in terms of I guess, because what we're seeing here is limited GDP growth, but actually still quite substantial growth potentially in logistics from what we're seeing. So is there less of a relationship now between GDP growth in a specific country and what we expect to see in terms of logistics demand and take up, Tobias?
Interesting question, Richard. We didn't show this slide in this webinar, but we have some slide decks available where we show the take up correlated with the GDP. And when we look at what is happening until the end of the decade, we are very conservative about the take up. But still, since GDP will increase on a slower pace, of course, we just saw it, there will be an increase in logistics floor space nonetheless. And for Germany, for example, we will see take up or demand from take up for roughly 8 million square meters a year. So this is still higher than what we saw during the, well, record-breaking high during COVID or the pandemic. Of course, at the moment is slowed down, and we all are waiting for the picking up or the pace picking up when it comes to the development. But for the logistics real estate, there is much potential left. For example, if you look, there are many things that comes to my mind. For example, if you look at the floor space per capita in the US, we have roughly about 5 square meters per capita. When you look, what do we see in Europe? Then there we have the Netherlands and Germany with the highest per capita ratio. It's roughly 2 to 3 square meters. So there's much space left. And when we look at countries like Italy, for example, it basically really started that they built up in logistics network. A few years ago, I guess 2 or 3 years ago, there wasn't even an Amazon fulfillment center in Italy. So, and when it comes to the consumer market, Europe is still one of the mostly sought markets in the world. There's a big consumer market. Even the German people are more at the moment saving their money because they're very cautious when it comes to spending money. That's different in other countries. And because they're very cautious about what's happening in the economic environment. When it comes to e-commerce, I'm very sure. Of course, we had a pause as a driver in the last 2 to 3 years after the big growth during the pandemic. But again, we see a shift in consumption behavior from the consumers. So there's much change to be in this behavior when it comes, for example, buying furniture. At the moment you go to a physical location, in the future you will go just online and shop your furniture. And this is basically starting. When it comes to e-food for buying your groceries, then there are certain countries which really hesitant to it because, for example, food is very important in France and Italy and in Germany as well. But still, many retailers are preparing to roll out big plans to increase this kind of providing foods or other goods to the people. And this is all online retail. So we expect many shifts towards e-commerce as well. And last topic, I won't dive into reshoring, with the exception you asked me to it, but we did a lot about nearshoring in the past. When it comes to the industrial development, there are many industries, for example, battery production or the production of chips, of semiconductors, which wasn't really part of what Europe did in the past. During the pandemic, we learned that it is very difficult when the situation with the supply chains is disrupted, the resilience, that we're really cut off from some of those markets. So from a strategic side, we still need to really build up such kind of industries. This is for sure. And there are many plans to do this in the future. in this couple of years with a very slow economic development, many of those plants are being paused. Not all of them. There are really many battery production and chip plants being just begun right now. Others are being paused until they know what's the situation is look like, because it's so fast development, for example, in the battery technology. So they're waiting until the situation changes, if it really, they know what kind of technology to build. And yeah, so we think there are many demand drivers around the corner, which is triggering additional take-up.
Okay, good. And Moritz, just coming to you, you mentioned the sort of positive drivers that there were in the market there. What are you seeing in terms of the investment side? Does that mean that there's a more positive take up there? Are we seeing more activity in the market? What's your sense of that?
Thank you for your question, Richard. Yes, I do think that at the moment there are more transactions happening than before, but the type of investments are a bit different. Where it was before, let's say until the end of 2023, 2022, start of 2023, there were still core investors, mainly German investors in the market, buying for the long term. We see at the moment more value add investors focusing on value add rental growth, or capex programs, and even developments. So yes, we do see the number of transactions increasing, but the type of investments are changing a bit.
Okay, great. I'm going to pick up on a couple of questions that have come in on the chat. Thanks very much to everybody for putting those in. Let's pick up first of all, and feel free, this is for anybody who wants to pick this up. Thanks, Ian Morgan, for this one. How do the panel view the weakness in industrial activity in Germany, especially in energy intensive sectors, versus all the talk of nearshoring being a longer term trend? Isn't there a contradiction between those two elements? So it'd be interesting to get your views on that, the sort of, you know, the weakness in terms of industrial activity, but also the nearshoring aspects. Does anybody want to pick that up?
I guess probably I should start with that. We have actually published on the question of energy-intensive sectors in Europe and Germany in particular. It's a very contentious topic, and it's hard to have a very straightforward opinion. If you just look at industrial production, you can fully understand all this discussion about deindustrialization in Germany. It's down for some sectors 15–20% from their peaks in the post-pandemic world. However, if you look at other things like value added, which is kind of a more better economic measure in our view, actually what you've seen in Germany is more like an industrial stagnation rather than a deep slump. So first off, there's already a question, how weak is German industry already? The way we would understand this is probably there's a sharp shift underway in industries. Some sectors are growing. Those are typically the higher value add sectors. Some other sectors, like the very energy intensive sectors, are probably underperforming. But as I said in the slide deck, even for the energy intensive sectors, it's not as straightforward as you would believe that they're just disappearing. For instance, yes, production in those sectors has tumbled, but if you look at trade in those sectors, actually the trade surplus we have in Germany in energy-intensive sectors is slightly above 2019 levels, which sounds very counterintuitive, but it tells you probably to a large degree the weakness in activity is more demand than competitiveness driven, because a lot of these intermediate goods, because of a lot of the energy intensive goods are intermediate goods. So if you think about the construction sector, a lot of wood, a lot of paper, cardboard, a lot of steel, cement goes into the construction sector, which is right now ailing. Of course, then you don't produce these things, and this kind of artificially skews the energy-intensive sector activity right now to the downside. And that's the main reason that we expect at least some, let's say, catch-up growth in those sectors. They are unlikely to outperform overall industry over the medium and long run, but in the short run, we think there's some catch-up growth. And the other aspect indeed is supply security. It is true that energy prices relative to, say, the US, because of natural gas or electricity, would make it more attractive to produce there. But if you look at wage costs, they have risen much, much more strongly in the US than in Europe. And second, of course, the relative incentives have changed, and there's some more support in Europe now, given the view that you need supply security. And typically those intermediate goods are making up only kind of a medium sized cost share of overall production. So we think it's not so much that we're optimists, but we're not as pessimistic on some of those sectors as others. And this should actually also be reflected in activity there. And indeed, Eurozone activity in energy intensive sectors has actually risen quite a bit in the last couple of months and outperformed the overall industry as this downward drag from the inventory cycle is ending. So there's some, let's say, more technical aspects that would suggest logistics and kind of this inventory holding to pick up a little bit in the next couple of quarters.
Okay, good. Question has come in as well from Savas Genser. Thank you, Savas, for that. And it also actually picked up on one of the kind of questions I'd got from the presentation in a way, which is that we're not looking at huge GDP growth here, as we mentioned. Savas puts this particularly into Germany, but it'd be interesting to get a general view on it as well. But it's kind of what could motivate potential tenants in Germany to agree to rent increases above inflation, given this weak GDP growth. So is there going to be more a scenario of moderate yield compression and decreasing construction costs? And will that make landlords more inclined to settle for moderate rate increases? So it'd be interesting, how do we see the occupiers versus, I guess, the landlords here in terms of rent increases? Because the prediction, Tobias, was that we were going to see, you know, continuing higher rent increases. Do you think that's going to work in terms of the occupier side? How do you see that playing out?
Well, of course, I can understand that occupiers say, okay, we face such a steep increase in rental values that they say, oh, please, let's talk about not increasing it anymore. On the other hand, we need to explain to them that, for example, financing costs really faced a steep increase as well. The construction costs, we just talked about it, faced a steep increase in well, and the plots of lands. Well, despite the situation, we have a bit more available plots of lands, and they got a little bit cheaper, but it didn't change our calculations so dramatically. So we really still are in need of increasing rental values. And when it comes to what does it mean for the occupier, we are talking about, well, this is depending on what the logistics service provider or the tenant is really doing. But often we're talking about 5 to 8% of total cost for them. So rental or the rentals value for their facilities is nothing, but it's much lower than the cost, for example, on the road for the transport costs they are facing. This is much higher. And here I make the connection to what Oliver talked in his presentation about what can artificial intelligence do for the logistics sector in the future. When artificial intelligence is introduced in the logistics service provider, they will first really focus on optimizing routes, optimizing their transport costs, because here's really the cost structure they really have to worry about. And it's not really about the rent increase in the warehouses. So that is more or less the focus when we talk with many of our tenants, they are working on. And then to get on addition, for many of them, it's for example, ESG components that they need to have a shift in regenerative ways of or reducing their carbon footprint in all of their supply chain. And this is not only the transportation cost, but also the costs in the warehouse. So they really are demanding. We need or are expecting we need more photovoltaics. We need more. So I'm lacking the English word for Wärmepumpe. Maybe you can help me out.
Heat pump.
Heat pumps. Yeah.
Thank you very much. So that is what our standard fit out for the new built facilities is looking like. And this is more expensive components. And this is what they're really demanding and expect to see. And this is reflected in the rent increase as well. And I think to add on what Oliver just talked about the industry, when we just look on focusing on Germany, on the rooftops of the logistics and industrial facilities as well, also not only logistics but also industrial. We're talking about 362 million square meters of rooftop space, and on these rooftop space, when we really are able to build photovoltaics on it on every facility, then we would be able to roughly produce 40 gigawatts of energy. So here is where energy transition and the restructuring of how we produce our own energy could be a solution. And this is only for Germany. And many of the industrial companies are also already working on it, because they saw depending on gas prices is really making them vulnerable to such kind of changes. Really being independent gives them, well, of course, at first it's investment, but later on it's resilience and independencies. And for some industries, this won't work quite good. For example, when it comes to steel production, they are really more focusing about changing to hydrogen, and this adapting to the new situation is, they need much investments, and the companies are really struggling with it. And you see it at companies as ThyssenKrupp, where they just reduce their production. We are really on a low when it comes to German steel production. This takes time, costs a lot of money, but this isn't the first transition we had to go through. I see more the problem of the red tape we are facing in our day-to-day business. That is really much of a problem, and we need to really find a solution for this.
Great. We've only got 10 minutes left, so I'm going to try and get through the other questions that we've got in the chat. So if we can be as quick as we can with these, that would be great. Interesting from Przemek and Pietek from CBRE, question about energy costs in Europe, roughly twice as high as in China. Is that affecting or slowing down relocation of production back to Europe, which is an interesting area, but also ties in, I think, with that element you were talking about there, Tobias, in terms of if we increase the amount of solar power and self-sufficiency in terms of energy for a number of these logistics units, that may shift the needle. So if anybody's got a view on that, that would be good. We have also from Anna, can anyone give an opinion on Portugal in relation to Europe advantages and disadvantages, a vision for the coming years? I'm assuming, Anna, we're going to stick to the logistics side for that. And finally, we have from Ruben here, a question regarding the economy. One of the key messages of the presentation was no deindustrialization, but a shift of sectors. However, Draghi published a report yesterday messaging that the EU must genuinely fear for self-preservation. Does anybody have a view on this in terms of any need for action? So if anybody wants to pick up on any of those, feel free to go now.
Should I start with the European energy cost, because that was the first question?
Fine. Why don't you take that, Oliver? Yeah.
All right. So our view is that Europe cannot compete really on energy costs, and it has never. There's also a bit of a misunderstanding that German model was built on cheap gas. Yes, it played a role, but in reality, German energy costs were always higher than elsewhere. So it was usually historically also about the efficient use of that energy. And in a way, we are now seeing, as Tobias said, kind of a new challenge, a new adaptation, and kind of the industry is now underway in terms of adjusting to a lower gas and lower energy using production methods. So higher productivity in the end might be or will be the outcome. And yes, there will be some shifts away from energy intensive products. The price, I think, will come down somewhat. There's a lot of investment going into renewables, but we have to balance it in the near term, because yes, the marginal cost of solar and wind power will be close to zero. However, all the investment needs that we have in terms of batteries, network, grids, and so on will in the near term counteract that. So I don't expect a big drop in energy costs really in the next couple of years. Some moderation that will kind of narrow the gap a little bit, especially in terms of gas. A lot of LNG is not so much about demand, but actually supply. A lot of gas fields are coming online. A lot of export capacity will come online in the next 2-3 years, which should somehow weigh on the global gas price a little bit. Still, we are going to be at a disadvantage, but usually we have been historically as well. There's always been above average prices. So it's kind of getting better from here, but it's not going to get great, and we need to kind of deal with that and have that investment. And maybe to make the connection to Draghi, in a way probably has overstated his case a little bit in order to get some urgency, if you will, into the discussion, and in a way rightfully so. But if you look in the substance of his contribution, there's nothing dramatically new in there. Most of the things, the analysis is well known. The benefit is really, it has been put into one report consistently with a lot of quite concrete proposals how to deal with it. My issue with that is, though, that I have not seen a lot of take up by national governments, or even von der Leyen yesterday. She was at the press conference but left after half of it. It doesn't look like there's a big pickup on his proposals right now, but it's really an open question. Is it really as dramatic as he's suggested? I'm not as sure. I think there's a lot we need to do, and we could be much better than we are right now. But there's already a lot of, if you will, structural shifts underway within industry. What's really interesting, for instance, a little nugget within European survey data, there's on net terms, industry wants to fire people. There's no demand, they're uncompetitive. However, the share of firms that still wants to hire is above average, relatively high compared to what you would expect given the dramatic production cuts that we have seen. The way I would see it is right now, those people who lose jobs, let's say from car makers, they will move on to work in heat pump producers, defense producers. There's a lot of jobs out there, industrial jobs that can be filled, and that will create new industry demand and supply. So I'm a little bit more optimistic. Nonetheless, I would totally agree with him that a lot of his proposals are well worth considering.
Okay, great. And Tobias, do you want to just pick up on if you have a view on the Portuguese logistics market for Anna?
Yeah, of course. What we saw, especially I was triggered to have a closer look on Portugal during the pandemic again, because then I saw that the industry is really that it was really manageable. It was really seeing that there are small manufacturers starting producing over there, and they really got they come to my mind as really. So I have a rather good view, or a good favorable view on Portugal. And when I understand it right from my Spanish colleagues, of course we are at the moment only active in Spain, but they have a monitoring Portugal quite close, because they see it's really a market where, for example, energy producing, there's lots of sun when it comes to hydrogen production, for example, for solar production. That could really be a market where such kind of energy intensive companies are or users could benefit from. And when earlier Oliver talked about maybe the northern shores of African countries could work in this kind of way as well. And then again, you mentioned the political uncertainty in those markets. When it comes to the workforce, for example, Algeria, with the election recently, really has a problem that many of the youth, the highly educated people from Algeria, is not starting a career in Algeria, but they're still going to Europe, starting as a career there. So we have the highly educated people from there in Europe. So I think because it's close to each other, the southern parts of, or the southwestern parts of Europe could benefit from it. So I'm monitoring Portugal quite closely and look how it develops. But I have a good initial view on it.
Okay, good. We're almost out of time, so there's only 1 minute left. So the original question at the beginning of the event was European logistics, real estate markets, is now the right time to invest? So I guess what's our view on that? Do we think now is the right time to invest? What's your take on it, everybody here? And I'll be interested to see what the comments are from the chat as well on that. But what's your take on that, very briefly?
Yes.
Okay. Yes,
as
that's good.
possible. No, but because we faced such kind of coming from a very high price situation, now being repriced, and I think we are facing a situation where we have a very good opportunity, getting good product on good locations. This is what the people, what the investors meant when they said, okay, we're looking at value add and opportunistic schemes. But maybe Moritz, if it's okay for you, I pass it over, because you're inside the investment market in the Netherlands, so it's maybe the best to answer it in your words.
Yes, I think it's a very good moment to invest, but you need to be careful. And exactly like you're saying, Tobias, the location is important. Development in the area is important. You need to look how the micro location is functioning, how the macroeconomics are handling. It's not something that was as easy like it was before. I think you should, and it's not only to give ourselves a little sponsoring, but you need to have boots on the grounds. You need to know what's happening in the area where you would like to invest. You would like to know what's happening with the tenant, etc. So yes, it's in my view, very good time to invest. But be careful.
Yeah, I think interesting to have that caveat there, because the market has definitely moved from being one where you could come in with capital and simply invest to a different position now, where it really is specialists, I think,
yes.
that are going to be successful in the next phase. Really interesting presentations, great discussion, and thank you to everybody for your questions in the chat, and for everybody being open in terms of answering it here on the panel. Really interesting, I think. Thank you very much to everybody who joined this live, and also thank you to everybody who's watching it on demand. Thank you very much, everyone.
Thank you.